All right, so one of the big topics in the budget obviously is rental properties, or so residential properties essentially, because commercial properties weren't caught up in the same sort of way. So residential properties, and using residential properties as an investment vehicle. So in particular, two big things, obviously the capital gains tax discount disappearing and the changes to negative gearing. So negative gearing will only be allowable on new properties. So now, what does it mean? It means that you won't be able to deduct any loss in the current year. So if the expenses of the property exceed the rent in any given year, you can't claim that against other income sources. You will be able to carry forward those losses in the same way that, say, a company losing money in a particular year can carry forward those losses. That will be available to carry forward to offset against future income from that property. So once the property is positively geared, you'll be able to offset that. So what will that mean? It's going to depend very much on the math. It may end up whereby, in some cases, people might be relatively neutral in terms of the amount of tax that they pay, but the timing of that's going to be vastly different, because generally it's about somewhere between 5 to 10 years before most properties are neutral to positively geared. Again, depending on where interest rates sit and the relative yield of the property. So what is it going to mean for people? Obviously, it's going to push investors into the new market, which means, counter what the government seems to be suggesting, I can't see how that makes it easier for first-home buyers to buy new places when they're now going to absolutely competing against negative gearing, which is going to be way more relatively lucrative from a borrowing perspective versus an existing property. So it's going to be very counterproductive for first-home buyers. It can't not be mathematically. So that's one issue. Second of all, it's another good example, I think, of politicians misunderstanding statistical categories versus real people. Because again, yes, there's been an explosion in the relative impact of negative gearing in the sense of what they calculate as foregone revenue. I won't go into that in a lot of detail because we have a very long video where we talk a lot of those details in more with the nuance of why that's occurred. But most properties don't stay negative geared for very long because the rent goes up and it exceeds. The whole point of buying a property is you've got a growing income stream that will one day exceed its cost and will continue to exceed its cost exponentially over time, and you end up with a separate income stream. It's not about the value growing, it's about the rent going up. Yes, the value will increase as a result of the rent going up because it's growth in income that drives the value, but it's a differential in cost versus revenue that creates the value. So it won't stay negatively geared very long, generally between 5 to 10 years. Now, yes, there may be a few people who flip properties in that sense and have been able to do relatively easily, but property is a very expensive thing to do, and having done the math of this with hundreds if not thousands of times, the vast majority of people I've seen do that really don't make a lot of money. People who do make good money out of property long term leverage it very significantly, and they borrow 100% or more of the property, and they hold it for a very long time, and the compounding effect of that capital is what ends up making the money. But they are positively geared somewhere between 5 to 10 years if it's a half decent property. If it's not positively geared within 5 to 10 years, then they're not making any money anyway. So changes in negative gearing aren't going to have the policy effect. It is going to skew towards new builds, obviously, for people who actually do want a negative geared. But there are other ways that this can be dealt with. So, for example, if there is other income offset within an entity, so things like property trusts, unit trusts, or investment companies will still be very viable vehicles where other earnings aren't caught up in at least the way it's been presented, aren't caught up in that. So again, there are many, in fact, many of you will have property inside things like trusts. And yes, the property itself might be negatively geared, but other trust income will offset that, and the trust can do so under these provisions. It appears that trusts, especially unit trusts, if not investment companies, will also be able to essentially offset that income rather than sort of feed through. So there will be other ways potentially of structuring investment properties in the future. Things like commercial property will certainly be potentially relatively more advantageous because they don't, at least so far, don't seem to be caught up in that. So what's it going to mean for the housing market? Anytime you increase costs, it has to be drag on prices. So the long-term effect has to be a slowing of property prices, you would expect. Do I see any major sort of, downturns or whatever? Maybe in pockets. We might see certain areas where you might get a relative downturn. The property market was already, in many places, had peaked and was sort of struggling to grow because of a whole bunch of other factors, particularly rising interest rates. So I don't see that changing in the short term. Yes, it will be a drag in the long term in terms of property prices, but I don't think that really changes things fundamentally in the short term in terms of from the investment strategy point of view. Interestingly, superannuation funds have also been excluded from this. So things like limited recourse borrowing arrangements in super funds, which are not uncommon, will continue to be very viable strategies in certain circumstances, particularly with related business assets and those sorts of things. So some of those strategies will be more advantageous for people to do that wouldn't have bothered in the past, would have done gearing in their own name or in, say, family trusts or whatever. Superannuation funds and self-managed super funds, obviously we required for that, will be vehicles of choice now to be able to continue to build property portfolios potentially. So there may be a little bit of a change there. Keeping in mind that superannuation, given its nature and the long-term nature of it, certainly suits that type of strategy, but we do have the ongoing legislative risk that those rules are subject to change. And again, with some of these changes effectively having a retrospective aspect to them, then the idea that changes in the future will be grandfathered and maybe a little bit less secure. So that's something that will be more prevalent in the future is borrowing arrangements through self-managed super funds, but probably more so in other structures. Will it have an impact on first home buyers? As I said, I can't see it having a positive impact in any meaningful way. If anything, it's probably a negative impact because first home buyers will have to buy their first home as an owner-occupied home in reality. So yes, maybe it pushes more people towards the 5% deposit scheme that the government announced a little while ago. But the idea of staying at home or living with friends in a cheap scenario while you negative gear another property is not going to be an option for young, medium to high income earners. So all up, I don't think it's going to have a huge impact on solving the housing problem that it's allegedly designed to focus on.